Hi, I'm Mike Schuman of Vermont VA Federal Credit Union, and this is Show Me the Money. It's a personal finance show. We're talking about issues of the day, things that impact people's personal lives. Something that's come up very recently is some of the volatility that's been going on in the stock market. So a lot of people have been asking me questions about that, and I figured that would be actually a good approach, something to talk about today. Because when you're investing in the stock market, a lot of people worry about the gyrations, the day-to-day gyrations of what happens. And of course, it's a concern, and it can be very, very scary. It went down almost 1,100 points within the first 5 or 10 minutes on a recent day, and then it went back up, and then went down. And so it actually gyrated approximately 5,000 points in one day, up and down, up and down. It ended up down something like 600 points in one day. And the next day it was up 600 points, and then ended up down 100 at the end of the day. And then the following day went up 600 points, and the following day went up 300 points. So the bottom line is, what it's doing is it's shaking, gyrating, it's volatile, and oftentimes what will happen is it shakes people who are a little anxious, it shakes them out of the market. And that's what markets can do. We're here to talk about the best way to approach personal finance and also how to succeed in dealing with the stock market gyrations. First and foremost, you have to understand that when you're investing in the stock market, what's happening is on a short-term basis, it's very psychological. There is fear, there is greed, and those things are what cause some of the gyrations on a day-to-day or even a minute-to-minute basis. The reality is, over the long haul, the stock market is looking at the earnings of corporations, and you're investing in American corporations. So ultimately, when you're investing in the stock market, you need to have a long-term time horizon. Time is your friend. You need to recognize that. If you are uncomfortable with the risk associated with it on a short-term basis, you have a few choices ultimately. If you can't sleep, maybe you shouldn't be in it, shouldn't be in the stock market, and some people shouldn't necessarily be in the stock market. You do miss out on an opportunity, especially if you have 20, 30, 40, 50 years before you actually need access to the funds for whatever your goals are. Predominantly in this country, a lot of people save into the stock market for retirement. That's the primary goal for a lot of people. So you need to be prepared if you're going to invest in the stock market that's going to go down. But also look at it this way. It's also an opportunity, because when the prices go down, people do get scared. But if you could buy something that is 20% less on one day, oftentimes you'll buy it. That seems to happen with everything in this country except for stocks. If you buy stocks 20% off, you're excited, you're happy, you tell everyone. But when you buy stocks 20% less, you're a little anxious. Is it going to go down more? Don't worry about that. If you're really going to be an investor for the long haul, understand the basic fundamentals are that you're going to be making money over the long haul. Think long term. Don't worry about the short-term gyrations. And if you do, have some cash available. If you have cash available in your retirement account or what have you, when the market goes down, look at it as it is a sale. It's a buying opportunity. So take advantage of that buying opportunity. Because as I mentioned, over the long haul, it has a huge impact that you're going to actually benefit. And I'll give you some examples. I often ask people, especially if they're younger, if they're in their 20s or 30s, do you have any idea where the stock market was 30, 35, 40 years ago? We're in 2015 as we speak right now. So let's talk about that. 42 years ago was probably the trough of what's known as a bear market. A correction is when the stock market goes down 10%. A bear market is when it goes down 20%. So in this circumstance, 42 years ago is probably the trough. It was about 650 on the Dow Jones Industrial Average. So 650 is where it was 42 years ago in 1973 at the trough. Today, as we speak, it's around 16,500. So that means if you bought at that time and you were scared because the market was down, it was actually down from 1,000 down to 650. People lost 35%, give or take, depending on what they're invested in. But they went from 1,000 to 650, and now it's 25 times that figure. 650 times 25, if my cursory math is approximately right. So actually, you've done very well in the past 42 years. Think back to 1980, 1981. It was still about 800 or 1,000. And then, once again, 800 or 1,000, it is 15 to 20 times that figure. Over time, it goes up. Think about the worst times of when the stock market was really bad and where you are now. Look at 1987. it was approximately 2,200 in October of 1987, actually a little bit before that. But it went down 500 points. Now that's a lot now, but it was a lot then because it was about 25%. The entire market in one day lost 25%. That, without question, is very, very scary. However, it went from 2,200 down to 1,700 in one day. Once again, we're about 10 times that figure. So even if you had bought at 2,200, it went down 25%, you're still ahead of the game. And you think back to some of the other crises we've had. It went to about 10,000 from approximately 1,787. It went to 2,000 around Y2K when everyone was concerned about computers, et cetera. And we had the NASDAQ going up. So it went to about 10,000. And then kept going up and up and up. 2007, 2008, we had another financial crisis, maybe second only to the Great Depression in this country. And the financial markets freezed up. And at the low, which was March of 2009, the market actually in the Dow Jones Industrial Average actually went down to about 6,500. So let's put this in context. Even if you bought in 1973, when it was about 650, you're still 10 times higher than you were from 1973 to 2009 at the trough, at the absolute bottom from what we've seen at this point in time. Even if you've done the same thing in 1987, it went down to 1,700 from 2,200, and then it went to 6,500. You're still talking about more than triple or quadruple in a matter of 30 years. And then you keep going. It keeps going up. Over time, it just reflects corporate earnings. And that's what people need to recognize. Take advantage of the fact that time, if you are young, is your friend. And if you are a little older and you're getting close to retirement, odds are you're going to live another 20 or 30 years. But if you're not comfortable and you're getting older, sell on your terms. Don't be selling stocks. And that's mutual funds that invest in stocks, exchange traded funds, or individual stocks. Don't sell them when things are crazy, because ultimately you want to sell on your terms when you're closing on your goals, and take advantage of up days, because we do have up days too. Do it when it's going to benefit you the most. So that's the general message. There are some other thoughts that I did have. Just remember, you want to take advantage of diversification. As has been said in economics, there's no such thing as a free lunch. Well, there is actually in economics, and that is when you diversify, because ultimately the US stock market's done very well down through the years. But actually, if you've invested in different stocks, emerging markets, maybe a little bit there. You invest in some bonds, you invest in Europe, Japan, other developed markets. Once again, over time, if you have a little bit in each basket, then you're going to actually benefit, because one of those baskets is going to go up more than the others. And the other ones may lag, but at the end of the day, be realistic in your assumptions. Over time, since 1929, the average return for stocks has been about 10%. So it's not going to go 10% constantly every year. That just doesn't happen. But if you diversify and you take advantage of time, as we talked about, over time, 10% is not necessarily an unrealistic goal to achieve, to attain. But you need to be diversified and you need to take advantage of time. And if you do get nervous, you have some cash available for when the prices go down. So you're buying low, you're getting a deal, you're getting a sale, which is always nice. And over the long haul, as I've mentioned, from where stocks have been to where they are now, you're definitely going to benefit. As you age, this is also one of the strategies that I look at. And take advantage of the fact that prices are coming down with stocks and mutual funds and ETFs. I think it's a good idea to invest a little more in dividend-paying stocks. Now, dividend-paying stocks as opposed to growth stocks, which generally don't pay a dividend. What is a dividend? A dividend is a cash check, but it's actual cash that you're going to get conceivably on a quarterly basis from a corporation or a variety of corporations, especially if you do diversify into mutual funds or exchange traded funds. Exchange traded funds are essentially mutual funds that trade throughout the day. So when the market goes down, not only is it great that you're going to take advantage of a sale, if you're buying an exchange traded fund or a mutual fund that's down, that means the yield, the amount of cash you actually get, is higher. And let me explain this. If you bought an exchange traded fund or a mutual fund at $100 and it pays $2 an entire year in dividends, so that's 2%. Let's say the market's terrible, just horrible. It goes from 100 from the investment you're looking at down to 50, and you're freaking out because you're concerned. Well, once again, that's why you have cash. Because you know what? You're still going to get that, presumably going to get that $2 dividend every year, but instead of it being 2%, it's now 4%. You just bought a stock or an ETF or a mutual fund that's paying 4%, assuming that the dividend is safe. Most times it is, no guarantees by any stretch of the imagination. But let's assume it's a good conservative blue chip fund that invests in good companies, that has regular dividends. And sometimes there are mutual funds or ETFs that only invest in companies that provide a growing dividend. So they have a history over 10 or 20 years where every year they raise their dividend. So what's going to happen is, let's assume that they don't generally raise the dividend, but just to be conservative, you're still getting 4%, but you actually may get more over time. Once again, you're going to benefit. Time is your friend on every level, on capital gains, but also dividends. Now let's go back to that example. We're talking about $50 is now 4%. If you want to get a 10% return, let's say you want to get a 7% return on your money. Well, you know what? You now have 4% right off the top. Now all you have to do is get 3% appreciation. Well, that's a lot easier when it's at 50 and time is your friend. So you only need to get 3% and maybe 4%, 5%, whatever your hope is. Don't be unrealistic. Don't expect 20%. Back in the 90s when it went up 20% on average every year, people thought that was the norm. It is not the norm, and their expectations were out of line. Be realistic with what the history is. The history is 8 to 10%. Be conservative about it so you can have an expectation that's reasonable. Those are the best approaches for this. As I mentioned, the market gyrates to scare you. Have cash available. Bear in mind, as I mentioned, older folks should cut back on stocks over time, preferably on up days, if they can do that. Now, also, if you're 60 or 65 and you look to retire soon, once again, you may live another 20 or 30 years. That means that your exposure to the stock market may require another 20 or 30 years. There's a rule of thumb with retirement that you should, your first year retirement, take out 4% of whatever you have in your pool, in your retirement funds. So if you're getting 3% on dividends, 4% is even better, then you don't even have to touch the principal. But if you're getting 3%, that means you're getting 3% from dividends, and 1% can conceivably come from drawing down principal. Automatically, you don't want to necessarily do that, but if you take advantage of these opportunities, you're going to have hopefully a bigger pool for your retirement savings, first and foremost. And second of all, if the dividends average out to, including bonds, if they average out to cash returns of 4% and you're taking out 4%, you're barely touching principal, and then you can save it for your estate, or you can use other things for it. Right now, banks and credit unions are paying very little interest. But for a lot of people, and this is important because I'm not standing here telling you should buy stocks. No, what I'm telling you is you need to understand and be educated. This is all about education and being comfortable with what you do. Having said that, return of principal for many people is better than fear to realize return on principal. You want to make sure that you're comfortable with what you're doing. If you are afraid of it going down and you're getting to a closer point in time where you need the money, you should be putting it into things that are cash or cash equivalents. That's the best approach because you need it for expenses, to cover health care and to cover your mortgage and what have you. Hopefully your mortgage gets paid off by the time you retire. As I mentioned, why does the stock market gyrate over time? Earnings determine stock values over the long term. The short term is driven by psychology and fears of recessions. It's fears of inflation, of high oil prices. This is going back historically why the markets have been gyrating. So it is fear of recession, fear of inflation, fear of high oil prices, fear of low oil prices. The past year, the price of oil has come down, and oftentimes what's happened is the market's gone down. Why? Because corporations drive earnings and drive the stock market. Well, oil companies are corporations too. They're not very popular, understandable. But having said that, what will end up happening is if they make less money, then the market's tend to gyrate a little more because it's earnings of all corporations. So it could be high oil prices, it could be low oil prices. All these things make things gyrate. It could be higher interest rates. Once again, these are all things that drive fear. It could be lower interest rate because there's a fear that the economy is not getting better. And there's an old saying, and that is, the stock market's not the economy is not the stock market. What are other fears we've seen recently? Greece was a big fear in May and June of this year. What was going to happen with them? Were they going to default on their debt? So the markets were gyrating then. They're just trying to gyrate and scare you like you're on a roller coaster, and so you jump off because it's too scary a ride. Recently, it's been of China, concerned about China, because they're having some difficulties with their economy. And then on top of that, the Federal Reserve is looking to raise interest rates. They've been talking about it for a very long time. There's a possibility it happens in September of this year. It's possible right now. There's about a 50-50 chance. A lot of people think automatically they're not going to do it because of the concerns and the fears in the market. It's unclear. They may still do it. If they don't, there's a possibility they'll do it in December just to get it done in 2015. They would like to at least raise rates once. They have not raised rates since, actually they've kept it at essentially 0% on the short-term rate, which is what they control, since December of 2008. So it's been 7 years, almost 7 years, where they've kept rates where they are. So they would really like to get off the dime because the economy has slowly gained traction. I'm not saying it's wonderful. It has gained some traction. The official unemployment rate is low. There's no fear of inflation, but they want to get ahead of the curve to a certain degree. That's the nature of the Federal Reserve. If your time frame is short and you can't sleep because of all the gyrations, you shouldn't be in stocks at all, really. You want to buy when the market's low. You want to buy when it's gyrating, when it's low. And you want to sell in your time frame. So short term, take advantage of those opportunities to buy at a discount. Like you're going to Walmart and you sell in your time frame when you're close to your goals and the market is higher. Sell in your terms, not when the market is volatile. If this is a discipline, buying low and selling high, because it's scary when it's down, turn everything on its head. Warren Buffett, one of his best aphorisms is when people are fearful, be greedy. When people are fearful, the market's going down. Be greedy. Have some cash available to buy. And when people are greedy, be nervous. When people are greedy, be fearful. That's an aphorism which I take to heart, and so I get a little nervous when it goes up. I enjoy the moment, people do, but the reality is you've got to be prepared for those things. If you can't do all these things, you've got to examine your philosophy on investing, and that's absolutely fair. But if you have goals, you're going to have to start saving more money and then putting it into bank or preferably a credit union. But rates are so low right now, as I mentioned with the Fed, that ultimately it's going to take a long time for you to realize your goals. There is something called the theory of 72. The theory of 72 essentially takes the number 72 and you divide it by your expected rate of return. Now I said the stock market generally goes up 10% over the long haul, but let's make it conservative. Let's say it's 8%. 72 divided by your expected rate of return of 8% is 9. That's the number of years it's going to take to double your money. So if you have $1,000 and you're getting 8% on average, in 9 years that becomes $2,000. Now, interest rates are so low right now at banks and credit unions. Let's say you're getting 0.5%, and sometimes you're getting that, maybe a little more on a CD, etc. So 72 divided by 0.5%, that is actually the number is 144. So that $1,000 to double it to $2,000 with interest, compounding, is going to take longer than most of us are alive. That's 144 years. So it's unrealistic to expect the interest to make the growth happen. It has to happen through increased savings. So these are some of the key concepts. Educate yourself. Hopefully this is extraordinarily helpful to you. And if you do have any questions, once again, Mike Schuman from Vermont VA Federal Credit Union, and I can be reached by email at mike@vtvafcu.com. Welcome back. I'm Mike Schuman of Vermont VA Federal Credit Union, and once again, if this is Show Me the Money. If you have any questions, feel free to email me at mike@vtvafcu.com. And we're just talking about the gyrations of the stock market because it's been on everyone's mind and there's concerns about their future, and it's certainly understandable. We're going to shift gears a little bit because there's some changes that are afoot with credit scoring. And I actually saw this morning from credit.com, which is a wonderful site where they have all kinds of good information. And it's actually stated how your credit score could rise soon without lifting your finger, which is a wonderful thing. Some credit report changes, and this is tied in to a new scoring model, which some creditors, some banks, credit unions, some lenders will use now as of September, and some will get delayed. What happens when they update this, Fair Isaac Company, FICO, they're on FICO 9. That's what this is going to be. Some lenders are still using FICO 7. So they update it, but lenders don't necessarily update it immediately. Sometimes there is a lag factor, some do. It's hard to say which way that is. And if you ask your lender, most of them won't actually know. But here's the impact that we're talking about. Medical debts are a big deal. Approximately 25% of all credit reports have some sort of medical debt, and they're usually small. It'll show a collection account for $10 or $15 or $20. But it doesn't matter the amount that's going to impact your score. It's the fact that it shows a collection account. It's a derogatory item. And when you have one derogatory item, then it's going to bring down your score. And we've talked in the past about what drives your credit score, and I'll get to that in a moment again, just to show you the key concepts of your credit score. But this is a big deal because it's going to not impact your credit score through a variety of approaches. The bureaus will institute a 180-day waiting period before they enter medical debt onto a consumer's credit report. So you actually have 6 months to get it straightened out, and hopefully you do so it doesn't show up in your credit report. Many health-related debts are the result of insurance confusion, other innocent mistakes. So consumers will now be protected by a grace period of 6 months, which is very nice. In addition, medical debts that have been considered delinquent but have been paid by insurance will be removed from credit reports, which is nice. Ordinarily, paid late notations remain as blemishes even after the consumer paid the debt. What does that mean? That means that $10, $15, or $20 copay will show as a collection account until you pay it. Then it's going to show as a paid collection account, which is very common to other debts as well. But now, once it's paid, it's automatically going to be removed, which is very nice. Changes the way credit scores are calculated, many that directly reflect the issues raised in a recent settlement, have already taken effect, as I mentioned, in FICO 9. So the question is whether the lender starts using FICO 9. FICO formulas are like software upgrades. Well, some people have gone to Microsoft Windows 10. Well, some people haven't, and that may take time before that happens, especially with lenders that they want to get comfortable with the updated credit scores. So we're talking about patience. Make sure that you do pay everything on time anyways, because it's going to help your score. And I'll get to that in just a moment. The adjustments for FICO 9 are just good for consumers. Bottom line, it's changed the impact that unpaid medical debt has on your credit score, reflecting the firm's research that unpaid health bills don't typically equate to bad payment habits. In fact, oftentimes what ends up happening is I've seen circumstances where these were the only delinquencies in the credit and everything else in the credit was good, but you know what? The credit score was lower than it would otherwise have been. So I can grant credit, I can grant a loan, but because the score is abnormally low, I would have to charge a higher rate because we do it based on credit scoring. Higher your score, the better your rate's going to be. Lower your score, the worse it's going to be. So it's an inverse relationship. So the median FICO score, according to FICO, Fair Isaac Company, whose only major negative references are medical collections, their score will actually go up by 25%, which is very, very nice. Meanwhile, there's a continued drumbeat for credit scores to include other non-traditional factors. What does that mean? That means that people who are out there, and they don't use credit cards or car loans or student loans, what have you, but they do pay rent, they pay utilities, etc. There's some discussion about having those listed as a line of credit. So your landlord or your utility, if you're paying on time, it's actually going to benefit your score. Usually that's an impact to people who are younger, who are trying to establish credit. Bear in mind, you can always get your credit report once a year from each of the 3 major credit bureaus through annualcreditreport.com. That is a government-mandated site that you as an American are entitled to 1 free credit report per year. So definitely take advantage of that through annualcreditreport.com. If you want your score, it's going to cost a little extra. It's about $18 or $19 per credit bureau, so just bear that in mind. There are other ways, of course, to do it for free. If you want to get your credit score from credit.com, there are 2 monthly credit scores that credit.com will actually provide to you. So it's definitely worth your while in checking that out. Bear in mind, we've talked about this in the past, what drives credit scores. This is important because ultimately we're talking about the price you pay for credit. Sometimes it can impact your ability to get credit. And as I mentioned, there are changes that are afoot that are regarding payment history. And as we've discussed in the past, your payment history, good or bad, is 35% of your score. 30% of your score is based on your balance to limit ratio. You keep balances low on credit cards and other lines of credit, home equity lines, overdraft protections. Balances low, credit limits high, your score is going to be higher. So that's 65%. As I always like to say, using credit wisely and sparingly is what drives your credit score higher. If you use it often, applying for credit on a very regular basis, maxing out your credit cards, paying slowly, those are things that are going to drive your score down. So once again, you may be able to get credit. You're putting yourself at risk to possibly not getting credit, but if you do, you're going to pay a higher price. It's essentially a tax. It's a premium that you can avoid. So if you can avoid it by any stretch of the imagination. Welcome back. This is Show Me the Money. I'm Mike Schuman from Vermont VA Federal Credit Union, and we've been talking about the gyrations in the stock market, and we're talking about the changes to credit scoring. So now we've moved on to, once again, what's on our Facebook page. We have some interesting things that are going on there. I'm not even going to get into great detail like I did our last episode, but some real fun things out there. So definitely go to facebook.com and look up Vermont VTVA FCU. And things that are on there right now. 10 do's and don'ts of financial planning. Things like failing to plan. People don't plan to fail, they fail to plan. Living beneath their means, things like that, so you can save and invest. Those are the basics. There's one thing on here we put on recently. 7 times being lazy costs you money. Good example they had mentioned, couponing. Not everyone likes to coupon, but if you do coupon, it's free money you're just throwing away. It could be $5 or $10 every time you go shopping. That's, if you spend $50 a week, that could be 5 or 10% that you could be saving right at the top. Eating out or going to the store and having to get prepared foods. There was one couple that made the determination to have the husband work and the wife worked at home raising the children, but they accumulated $47,000 worth of predominantly credit card debt. So they put their story on the site. We're paying off $47,000 worth of debt. So that's another story that's on there. Another one of interest is maxing out 401k is profitable. How is maxing out your 401k profitable? A, you're putting away money, you're saving, you're living beneath your means. B, by doing that, you're actually increasing your wealth, because you can put in up to $17,500 a year in your 401k. Doesn't mean everyone can do it, but the government allows you to do that if you're under 50. Or you can put up to $23,000 as of this year if you're 50 or older. So think about that. Even if you get 0% on your return, you're growing that asset, 17.5 every year or 23 every year. And if you invest it once again for the long haul, as we discussed earlier, the idea is that this is long-term savings / investment. So that's the idea, trying to find ways to save money, grow wealth, and make sure that at the end of the day, there's an old radio talk show host who used to do personal finance by the name of Bob Brinker. I'm a big fan of his, and he said growing critical mass. Critical mass is enough money that you can retire on. And so if you have enough money to retire on, and you did, as I mentioned before, about putting money to dividend-paying stocks that are paying 3 or 4%, including bonds and everything else, and you have enough money, you can just live off of that, which is a very nice approach. The idea is, when we do the show, is success. Saving money with a higher credit score when you're going to buy something, so you actually pay less in interest. So you can actually save money for your goals, invest it so you make money. One thing that I didn't even mention that is also helpful, saving money, is when you invest in an IRA, you should do it in the lowest cost provider. Index funds are a good example of that. They cost less than mutual funds where they have a professional manager. So you can save money there. There are a lot of approaches. So this is Mike Schuman from Vermont VA Federal Credit Union. I thank you for listening. If you have any questions going forward, my email, once again, mike@vtvafcu.com. Thanks for watching. Show me the money.